Bill Lee is the chief economist at the Milken Institute. Bill's with me now. The question we always need to understand with China is the situation worse than we are being led to believe?
It could well be, because one of the things that we've seen in the post Xi Jinping election is that he's consolidated power and information has become much more difficult to obtain. He has, for example, cut off any sources of private information so that the only sources of information we get about the Chinese economy and what's going on is from official sources.
We've always had dubious doubts about the GDP number. Most economists, I know, will sort of take it with a pinch of salt and a look in the opposite direction. But the real core question is, do we in the West or in the developed economies, do we need China to prosper ourselves?
That's the question that all of us at Milken have been asking. All of the sponsors are asking, is China investable? And do we need to invest in China? After all, the globalization has shifted to the point where everyone wants to replicate supply chains and not depend on sole sources anymore. And China's been the sole source of a lot of electronics goods. And a lot of investors are thinking maybe we should be shifting resources along with the Chinese resources that are exiting China into Vietnam and other parts of Asia to be able to have safety and soundness in our supply chains.
So a subpar growth China means what for the US, the EU and above?
Well, China's subpar growth really is two-faceted. On the production side, China has been the producer of all these goods and services for the rest of the world. And when they slow down and not produce as much, it's because the Western economies have also slowed down and shifted their consumption. As the West, the US and Europe are fighting inflation, we have slowed our economies down. And so we're importing less stuff from China. But at the same time, the shifts have gone on in terms of consumption. We no longer want as many goods. We want to have more services. So for the rest of the world, it really means very little, because we are really very little dependent on China's imports.
Okay, but to the extent that there is a shift that's taken place, how far is it permanent and systemic, and how far is it transitory and reactive? For instance, the supply chain issues which have unwound themselves, but have Western companies found new suppliers, therefore will not be going back to China in the same numbers? In other words, China's lost.
And it would be, but China has also managed to shift its own production. For example, it's become a major supplier of electric vehicles. Tesla, in fact, it makes most of its profitable vehicles in China, and China's a supplier of batteries. So in that sense, China has a monopoly in many of the very critical areas. But you're right to say that a lot of the lower value added stuff, manufacturing has moved out of China to Vietnam and other places in Asia, which is part of the Chinese Communist Party's plan to try to shift their production to more high value added stuff. So this mix of stuff that's going on is very fluid. And in terms of assessing its impact on the US and the rest of the world, depends really on what sectors you're looking at.
If we look at bond yields and the way the bond market has been reacting, both in China and in the United States, it's very difficult to get a grasp on where we think bonds are headed at the moment.
Very much so. In fact, one of the things that we've always been talking about has been whether the long-term interest rates are going up because of expected inflation going up, or is it going up because the Fed lacks credibility in whether it's going to hit its 2% target. But vis-a-vis China, if China were a robust growing economy, that would be fueling more inflation in the future. But right now we see that China's hopes for reviving its economy depends on the private sector, and President Xi's policies toward the private sector really lack credibility in terms of trying to revive the private sector because of what it's done to so many of the successful private sector companies like Alibaba and Tencent.
Bill, I promise you I will not hold you to this. I will not shamelessly throw this back in your face on a future occasion. But are you in a recession camp in the US, whether it be Q3, Q4, next year, whatever? Or do you think skirts by and soft landing, get ready?
I used to be a Fed staffer, and I trust in the forecasts of my Fed colleagues, and the board forecast is now showing that we are going to have a very soft landing. There'll be a slowdown, but it won't be called a recession, and we may not get the rise in unemployment up to 4.5% that really pushes us into that kind of world of a recession.
Okay, but I'm sorry, going to have another bite at this cherry. Don't we need that increase in unemployment? It's not nice, but don't we need that? Because that's the evidence that the economy is slowing sufficiently to meet your 2% target. Without that increase in unemployment, you're really not going to slow sufficiently.
Bingo, Richard. As an old forecaster, I would have said we absolutely needed that recession to get us to 2%. But now, in this post-COVID world where supply chains are so critical in getting inflation down, we may not need that 2%. We may not need a higher employment to get to 2% inflation. That immaculate disinflation may actually take place if expectations are nailed down firm enough.
It just shows us that you and I have to talk more about this on Quest Means Business. Very grateful for your time. Thank you. And so let's